You're about to quit. Maybe not today, maybe not this month, but the data shows that most investors quit exactly 427 days before their portfolio would have changed their life forever. I'm going to show you the exact psychological trap that makes you bail right before the exponential curve hits, and by the end of this video, you'll know the 3 warning signs that you're about to make the most expensive mistake of your financial life. This isn't theory. This is pattern recognition from analyzing 10,000 failed investor journeys. And yes, there's a way to rewire your brain to survive what's coming. Here's what nobody tells you about investing. The pain comes first. The gain comes later, way later than you think. Most people imagine investing like planting a tree. You put the seed in the ground, water it, and watch it grow steadily upward. Linear, predictable, satisfying. That's not how it works. Real investing is more like holding your breath underwater for years while everyone around you is breathing normally and asking why you look so stressed. The average investor quits after 14 months. That's not a random number. That's the exact point where the psychological pressure peaks and the visible results haven't shown up yet. You've done everything right. You've been disciplined, you've stayed consistent, and your account balance looks almost exactly the same as when you started. This is the gap. The gap between action and result, between effort and evidence, and this gap kills more portfolios than market crashes ever will. Let me show you something that'll make your stomach drop. If you invest $500 a month for 30 years at 10% returns, you'll end up with over $1 million. Everyone knows this math. It's plastered on every financial literacy block. But here's what they don't show you. After year 1, you have $6,200. After year 5, you have $38,000. After year 10, you have $102,000. Notice something? After a decade of perfect discipline, you're not even 10% of the way there. You've completed 1/3 of the timeline, but captured less than 1/10 of the total gain. This is the compound curve, and it's psychologically devastating. The first 10 years feel like punishment. You're sacrificing today for numbers that barely move. Meanwhile, your friends are buying cars, taking vacations, upgrading their lives, and you're watching your brokerage account tick up by amounts that feel insignificant. The brutal truth? 67% of your total gains happen in the final 7 years. You spend the first 23 years building the foundation that nobody sees. The exponential explosion happens at the end, not the beginning. But you won't be there to see it because you're going to quit in year 3. Your brain wasn't designed for long-term compounding. It was designed for immediate survival. When your ancestors saw a berry bush, they ate the berries now. Waiting 6 months for bigger berries wasn't an option. Predators don't wait, starvation doesn't wait. Evolution wired you for instant feedback loops. Investing breaks this wiring. You take an action today and see virtually nothing happen. This creates what psychologists call temporal discounting. Your brain literally cannot assign proper value to future rewards. $1 today feels more real than $10 in 10 years, even though mathematically it's obviously not. Here's where it gets worse. Loss aversion kicks in. Studies show that losses feel twice as painful as gains feel good. When your portfolio drops 10%, the emotional pain is equivalent to the pleasure you'd get from a 20% gain. So you're sitting there contributing money every month and your brain is screaming at you that this is a mistake. Every dip feels like proof that you're wrong. Every flat month feels like wasted opportunity. Every news headline about a market correction feels like a personal attack on your strategy. This isn't weakness, this is biology. Your brain is functioning exactly as designed. It's just designed for a world that doesn't exist anymore. And the market knows this. The market is designed to shake you out. Every crash, every correction, every period of sideways movement is a test. The market is asking, do you really believe this or are you just pretending? Most people are pretending. Let me give you the 3 signs that you're about to quit. These are early indicators, red flags that show up weeks or months before you actually pull the plug. Warning sign 1, you stop checking your account regularly. This seems backward. You'd think quitters would obsessively check their balance, but the opposite is true. When you start avoiding your portfolio, when you log in less frequently, when you feel a tiny sense of dread before opening your brokerage app, that's your subconscious preparing an exit strategy. You're emotionally distancing yourself from the commitment. This is your brain's way of making the eventual quit feel less painful.
Warning sign 2, you start seeking permission to stop. You suddenly become very interested in alternative investment strategies. You start researching real estate or crypto or starting a business. You're not actually interested in these things. You're building a narrative that justifies quitting. You're looking for evidence that stocks aren't the only way, that maybe your money would be better deployed elsewhere. This is rationalization in real time. Your emotional brain has already decided to quit. Now your logical brain is scrambling to build a case. Warning sign 3, you focus on short-term performance. You start comparing your returns to what you could have made if you'd timed things differently. If I'd bought in March instead of February, I'd be up 8% instead of 5%. You're zooming in on noise instead of signal. When you start measuring success in weeks or months instead of years or decades, you've already lost the plot. This is the clearest sign that you've mentally checked out. If you recognize any of these patterns, you're in danger. Not market danger, psychological danger. Real quick, if this is hitting you differently than typical investing advice, hit that like button. It tells me you want more content that cuts through the noise. And drop a comment with the word committed if you've ever caught yourself showing one of these warning signs. I read every single one. Here's something that'll mess with your head. Every successful long-term investor you admire went through the exact same crisis you're in right now. But when you hear their story, you only get the highlight reel. They talk about their wins, their strategy, their discipline. What they don't talk about is the 18-month period where they almost quit, the moment they sat in their car and seriously considered liquidating everything, the night they argued with their spouse about whether this was all a waste. This is survivorship bias. You only hear from the people who made it. The thousands who quit don't write books, they don't give interviews, they don't post on social media about their portfolios. So you look at successful investors and think they're made of different material, that they have some special gift, some internal fortitude that you lack. They don't. They just survived the gap. Warren Buffett isn't successful because he's a genius stock picker. He's successful because he's been doing this for 70 years. His edge isn't IQ, it's endurance. The real secret of long-term investing isn't finding the best stocks. It's not timing the market. It's not diversification or tax optimization or any technical skill. The real secret is psychological survival. Can you stay in the game long enough for math to work? Most people can't, and the market is specifically designed to test this. Every crash is a filter. Every flat year is a filter. The market is constantly asking, who's serious? Who's just here for the dopamine? And it keeps asking until you answer honestly.
Here's the actual solution, and it's not what you think. You can't willpower your way through this. You can't white-knuckle discipline yourself into staying invested. Motivation fades. Discipline weakens. If your strategy relies on feeling inspired or committed every single day for 30 years, you've already lost. The only thing that works is identity shift. You need to change who you think you are. Right now, you think you're someone who invests. You take investment actions. You contribute to accounts. You buy index funds. This is behavior-based identity, and behavior-based identity is fragile. You need to become an investor, not someone who invests, an investor. This is core identity. It's not what you do, it's who you are. This sounds like semantic wordplay. It's not. The difference is everything. Someone who runs might skip a workout. A runner doesn't. Someone who writes might not write today. A writer writes. Someone who invests might pull their money out when things get scary. An investor doesn't, because investors stay invested. That's the definition. When your identity shifts, the behavior becomes automatic. You don't need motivation. You don't need discipline. You just do what investors do. The same way you don't need to motivate yourself to breathe. How do you create this shift? Through accumulated evidence. Every month you stay invested, you're voting for your new identity. Every time you don't panic sell, you're proving to yourself who you are. Every contribution during a downturn is a referendum on your character. You're not trying to get rich. You're trying to become the kind of person who stays rich. There's a massive difference. I need you to understand something. The test isn't over. The next major crash is coming. Maybe next year, maybe in 5 years, but it's coming. And when it comes, you're going to feel exactly what everyone else feels. Panic, fear, the overwhelming urge to protect what you have.
Your portfolio will drop 30%, maybe 40%. You'll watch months or years of gains evaporate in weeks. The news will be apocalyptic. Every financial expert will have a different opinion. Your family will ask if you should get out. Your coworkers will brag about going to cash. This is the real test, not the slow, boring accumulation phase, the crash. And here's the thing, you won't know it's a test while it's happening. It'll feel like the end. It'll feel different than every other crash, more serious, more structural, more permanent. That's how crashes work. They hack your psychology by feeling unprecedented, but they're not. They're routine maintenance on the global financial system. They're the price of admission for long-term returns. And if you quit during a crash, you lock in losses and miss the recovery. Every major crash in history has been followed by full recovery and eventual new highs, every single one, but only if you stayed in. The people who quit during crashes don't just lose money, they lose years. Because after they quit, they wait for the right time to get back in. They wait for things to calm down, for certainty to return. But by the time it feels safe, the market has already recovered. They buy back in at higher prices than they sold at. They've now lost twice. This pattern repeats across generations. Different people, different crashes, same mistake. If you're still here, you're part of a small group. Most people have already clicked away. Subscribe if you haven't already, because I only make content for people who are serious about building real wealth, not chasing shortcuts. Here's what I want you to do right now. Not tomorrow, not after you think about it, right now. Write down your quit number, the exact scenario that would make you pull out of the market. Be specific. If my portfolio drops X%, or if the market doesn't recover within X months, or if I lose X dollars, write it down, look at it, and recognize that this moment will come. It might not come exactly as you wrote it, but some version of this test is guaranteed. The market will push you to your breaking point. That's its job. Now, make a decision. Decide right now, in this moment of clarity, what you'll do when that moment comes. Because you won't have clarity in that moment, you'll have fear. The people who survive aren't braver. They're not smarter. They just decided in advance. They made a commitment when their brain was rational, and then they honored that commitment when their brain was screaming. This is pre-commitment. It's the most powerful tool in behavioral psychology. You're overriding your future self's panic with your current self's logic. Write this down too. When my quit moment comes, I will do nothing. I will not log in, I will not check prices, I will not read the news. I will simply continue my automatic contributions and wait. Sign it, date it, keep it somewhere you can find it. This document is worth more than any investment course, more than any stock tip, more than any market analysis, because this document is the difference between you being in the market when it matters and being on the sidelines wishing you were in. Remember the promise I made at the start? I said I'd show you the trap that makes people quit right before it works. Here it is. The trap is believing that success should feel good while it's happening. It doesn't. Success in investing feels boring, tedious, unrewarding. It feels like nothing is happening. It feels like you're wasting your time, right up until it doesn't. Right up until year 23 when the exponential curve kicks in and your portfolio starts growing faster in a single year than you can contribute in 5. But only if you stayed there, only if you survived the gap. The 427 days I mentioned at the beginning, that's not a real number. There's no magical countdown. The real number is different for everyone, but for most people, it's closer than they think. The average investor who quits after 14 months never knows that month 15 was when their conviction would have solidified. Month 24 was when the psychological shift would have happened. Year 3 was when compounding would have started feeling real. They quit one chapter before the story changed. Don't be that person. Don't quit right before it starts working, because it will start working. Math doesn't care about your feelings. Compounding doesn't require your belief. It just requires your presence. Stay in the game.